Hi and welcome everybody. I am Kristen Biermeyer and I'm the marketing manager for Wagner CPAs. And I am so happy that you could all join us today as we talk a little bit more about the COVID relief programs and what's available for you. During the presentation today, if you have any questions, those can be submitted through the Q&A feature that's at the bottom of your screen. And our panelists will be monitoring that Q&A during the presentation. We'll try to address your questions as they come in or at the end of the webinar as appropriate. We'll try to get through all of them today. The presentation is being recorded, so you can reference it later. It'll be emailed to you after today's event. Our panelists and presenters today are Kate Serpy and Dan Bergs. They are both senior managers at Wagner CPAs. And now, Kate, I will turn things over to you first.
Great. Thank you, Kristen, and welcome everybody. It's been a little while since I think we've done a COVID update, so happy to be back. It feels like not that long ago that we were doing these pretty regularly, so sort of glad to have that a bit behind us now, but wanted to make sure that we sent out an update, an overview, kind of a status, where the programs are that we've been talking about for the last year and a half, and kind of walk through some statistics and what's still available for you to be taking advantage of. So just to kind of give you an overview of what our topics are going to be today, we're going to touch a little bit on the Restaurant Revitalization Fund and the Shuttered Venue Operator Grants. We'll talk a little bit more about the PPP Forgiveness and some statistics there. We'll also talk a little bit more in depth about the Economic Injury Disaster Loan Program. And then we'll give you some more in-depth information on the Employee Retention Credit and also touch a little bit on the Families First Coronavirus Response Act, or FFCRA. So inundated with acronyms again, but we always love a good acronym. So first, we're going to talk about the Restaurant Revitalization Fund, or RRF, as it's been called. As a reminder, this grant application period is closed. All of the funding for this program was exhausted quite quickly. It was a grant, so if you did receive money through the Restaurant Revitalization Fund, you are not required to pay it back unless all funds were not used for appropriate purposes, or if your business permanently closed before you were able to use all of the funds. The covered period for using RRF funds was February 15th, 2020, so last year, prior to kind of the start of everything pandemic related, through March 11th of 2023. So you actually have another year and a half to use those funds. All recipients must report those funds used via the application portal by year end. So again, if you did receive this funding and you have used all of the funds, you're going to need to report via the application portal by year end. They will walk you through that process on the portal. If you have not used all of your funds by this calendar year end, you will be required to report on an annual basis, again, via that application portal. So if you go to the sva.gov website, search through to find the Restaurant Revitalization Fund, and then you can have access to the portal, which if you received a Restaurant Revitalization Fund, you'll use that same login information that you set up when you applied for the grant to log into the portal and report the use of the funds. Again, whether you've exhausted them all by the end of this year, or if you have more money and continue to use them through that March 11th, 2023 period. So just wanted to kind of give out a few statistics around the Restaurant Revitalization Fund, because I think obviously it's important to understand where these dollars went, how they were allocated, how they were used. So the Restaurant Revitalization Fund was one that was a little bit, there was quite a bit of scrutiny around it because of how few dollars were allocated to the program. I say how few dollars, of course, $28.5 billion doesn't seem like too few dollars, but thinking about all of the restaurants that had struggled throughout the course of the pandemic, $28.5 billion definitely didn't come close to covering the need that was going to be anticipated. So they did expend all of those funds, that $28.5 billion, and a little over 100,000 restaurants got funding through this program. But as you can see, over 278,000 restaurants actually applied to receive grant funding through this program, totaling over $72 billion. So this program was essentially underfunded by, close to $45 billion. It's hard to wrap your head around billions of dollars versus millions. So it was largely underfunded and there was a lot of scrutiny there, but you can see the grant size, the overall average grant size was about $283,000. So what that means is it means that a lot of smaller restaurants were able to get access to this grant funding, which was good news, certainly for those smaller organizations that were hit hardest. For the Shuttered Menu Operator Grant, this initial grant application period is also closed. However, for this grant program, all of the funds have not yet been exhausted. So right now, while you can't submit a new application, if you already received a Shuttered Venue Operator Grant, you should have received an email if you were eligible for a supplemental grant. Those emails, I believe, went out about a month or so ago. So if you didn't receive that email, but you did receive a Shuttered Venue Operator Grant, I would recommend going on the SBA.gov website and following up with their SVOG customer service to see why you didn't receive an email. To be eligible for those supplemental grants, you had to have suffered a 70% or greater revenue loss for the most recent calendar quarter compared to that same quarter in 2019. So again, if you did receive an email but weren't sure about applying for the supplemental grant award, you would be looking at comparing your third quarter 2021 revenue to your third quarter of 2019 revenue. And you will have needed to suffer at least a 70% or greater revenue loss to be eligible for the supplemental funds. If you do deem that you're eligible for those supplemental funds, you are eligible for up to 50% of your initial award, as long as it doesn't exceed the $10 million total grant award. As a reminder, always important to maintain your records. Specifically for SVOG, you must retain any employment records, so payroll reports, payroll tax filings for at least 4 years following receipt of the money. And all other records, so any records related to operating expenses paid, those records you have to keep for at least 3 years. You also must initiate the closeout process, so reporting on how you use the funds no later than 120 days after the end of your budget period. And again, you have to input this information into the SVOG portal, which will be the same portal that you use to access to apply for the grant. The closeout process includes submitting an expense report and in most cases a form SF-425, which is a federal grant reporting form. You would have filled out a budget when you initially applied for the grant. So you're going to have to report those expenses based on the budget you initially provided. So if you did receive a Shuttered Venue Operator Grant, make sure that you are visiting the SBA.gov website and reviewing the program guide and the FAQ section. Again, just a few stats to kind of give you an idea of where the SVOG program is right now. To date, this is as of midday November 15th, so this is quite recent. There were about $12.9 billion in grants awarded, and 12.3 of that 12.9 billion had actually been dispersed to grantees. There were over 17,000 applications submitted, with almost 13,000 of those having grants awarded. That was in the initial round of funding, which was about $10.5 billion. In supplemental awards so far, about 6,900 invitations were sent out to those that had received initial funding, and they have awarded approximately 6,700 supplemental grants totaling $2.4 billion. This program, I believe, had about $16 billion, 15 or $16 billion allocated to it. So you can see that there is additional funding. So if you did receive an initial grant and you do feel that you will be eligible for supplemental funding, make sure that you follow up on that. PPP, everybody's favorite topic. So at this point in time, PPP, there's no applications. The program is over. The deadline to apply was May 31st of 2021. All of the funds for the program were expended. So it was close to $800 billion that was allocated to the PPP program. I did kind of a count based on anybody that might have applied by that May 31st date, although I think the funds had been exhausted prior to May 31st. So for the most part, anybody that received a PPP2 loan towards the end, towards that May 31st date, your 24-week period should be over, which means that you'll want to start thinking about applying for forgiveness. So just kind of wanted to give you an overall picture of the volume of the program, again, close to $800 billion between the PPP1 that was allocated out and starting in March of 2020 through the PPP2, which was over as of May 31st of this year, close to $800 billion. Of that $800 billion, $628 billion has actually already been submitted for forgiveness. So that's PPP1 and PPP2 loans. So many people have been aggressive about applying for forgiveness, which is great to see. Of that 628 billion, almost 611 billion of that has been fully forgiven or partially forgiven by the lenders and by the banks. So again, great to see. Only about 18 billion total has not been forgiven based on the applications submitted. So as a reminder, you're going to want to be thinking about getting those applications in for forgiveness. So some important reminders when you're thinking about applying for forgiveness. You can actually apply for forgiveness anytime up to the maturity date of the loan. However, if you do not apply for forgiveness within 10 months after the end of your covered period, so typically that's going to be the 24-week period, your payments are no longer going to be deferred. So essentially what that means is, let's say your covered period ended on October 31st, but you wait until November 1st of 2022 to apply for forgiveness. You will likely have had to have made 2 months worth of payments on loan before that loan is forgiven. The loan still can forgiven in whole. So you would be refunded the payments that you made, including interest, but you will have to start making payments if you do not apply within 10 months of the end of that covered period. So it's important to keep an eye on that date. It doesn't mean you have to rush to apply for forgiveness right away, but it does mean that you want to keep that 10-month period on your radar so that you aren't forced out of that deferment period. Ideally, you don't want to have to make any payments if you don't have to. There are a couple of ways to be applying for forgiveness. If your lender has a portal that they require that you use, you'll want to, again, access that portal via your lender's website. If your lender does not have a portal that they've been using, you'll want to just make sure that you're in touch with your lender or banker to find out what the process is going to be. Otherwise, if your lender is part of the SBA Direct Forgiveness Program, you can actually apply directly through the SBA Direct Forgiveness portal, which is just, it simplifies the process a little bit and speeds it up. The loan still does have to get approved by your lender, but because it's going straight through into the SBA system, the timeline for getting the SBA's approval turnaround appears to be quite significantly less. And they're also going to vet the information that you send them for supporting documentation. So it makes the process a little bit easier. I believe we'll be sending out these slides after the webinar, and they'll be available on our website. So there are some links included in this presentation. The link that is provided here is going to give you a list of all of the lenders that are participating in the SBA Direct Forgiveness portal. If your lender is participating, there is a good chance that you might actually not be able to apply directly through your lender. So you'll want to make sure that you have a clear understanding of how you're going to need to apply for forgiveness once that time comes. Just a couple of additional reminders on PPP forgiveness. There are 3 different potential forms you might use to file for forgiveness. If you received a loan of $150,000 or less, and again, if you got a PPP1 and a PPP2 loan, this is not in the aggregate. Each loan is treated separately. So if you received a PPP2 loan of $150,000 or less, you have to use Form 3508S. That's a very short, simplified form. You do not need to provide any supporting documentation to the lender or through the SBA forgiveness portal. However, it's important to note that you do need to retain those documents in your files. We have already started seeing the SBA come back and review loans. I can give you an example that makes it pretty clear that all loans are subject to SBA review. I spoke with a client not that long ago who received a review notice from the SBA, and their loan was for $22,000. So that means that the SBA is crossing all their T's and dotting all their I's, and there is potential that they may be requiring backup documentation after the fact for any size, any and all of the loans. So make sure that even though you may not have to submit that backup documentation immediately when you apply for forgiveness, you do want to make sure that you have that documentation available, because the request from the SBA when the loan came up for review indicated that documentation must be sent to them within 10 days of receiving that request. So that's a pretty quick turnaround time. So you're going to want to make sure that you have all of that information ready to go. For loans greater than 150,000, you have two options, Form 3508EZ or Form 3508. I'm not going to go into all of the details about which form to use when. We have done quite a few other presentations about the specific forms and when you can use them. So I would recommend visiting our COVID-19 resource page on our Wegner website, and you'll be able to find some additional information related to the different forms that you can use. You do have to meet specific requirements to be able to file Form 3508Z. It's a little bit shorter. The long form, Form 3508, includes a Schedule A and a Schedule A worksheet. So there's some additional information that you have to calculate as it relates to filing that long form. So again, just important to remember, all loans are subject to SBA review and or audit. Doesn't matter if you got a $5,000 loan or a $5 million loan. The loans of $2 million or more are guaranteed to be audited, but that doesn't mean that loans under $2 million might not be. Just make sure that you've got that documentation ready to go if you were to be called for review or audit. The last thing I'm going to touch base on is the EIDL program. So this is actually one program that is still open and available. So if you're still struggling as it relates to the COVID pandemic, the EIDL program has not exhausted all of their funds. And so the funding is still available. Applications right now are open until December 31st of this year or until the funds are exhausted. I believe there was still a couple $2 billion left in the program. So if you are in need of some working capital cash, this might be a resource to look at. If you already received an economic injury disaster loan, you can also request an increase in that loan through the end of this year. Right now, the loans are up to $2 million. And to be eligible for this program, you must have suffered working capital losses due to COVID pandemic. So that's the only way that you can be eligible. So if things went pretty well for your business last year and this year, you will not be eligible for this program. And they do request supporting documentation in the form of financial statements, and they'll be looking at tax returns as well. And you have to fill out a Form 4506T, which will give them access to be able to pull tax returns to verify information. So make sure that you've kind of done your homework to determine that you are eligible. Of course, worst case scenario is that you would be denied that loan. I have linked the application portal here. It's directly through the SBA website. So if you are interested in looking into this funding, you'll be able to click on that link to access that loan program. A few facts about EIDL before you jump in. These funds can be used for operating and other ordinary business expenses. And they did update the terms so that you can now use it to prepay business debt. So if you have a mortgage on a building that's in the business, again, you've suffered working capital losses as it relates to the COVID pandemic specifically. And let's say you have a mortgage through your bank that's, let's say there's $500,000 left on that mortgage. Now do have the ability to take out an EIDL loan to essentially refinance that. You can make a prepayment on that mortgage, that business debt, and then you can use the EIDL loan. The terms are 30 years. It is a loan. There is no forgivable portion as it relates to EIDL. So you will be paying these funds back. The loan term is 30 years. The payment deferral is 2 years from the date of the first disbursement. Interest does accrue in that 24-month period, and then you would be paying the loan back over the next 28 years. So essentially it's a It's a 30-year loan, but you don't have to make payments for the first 2 years. The interest rate is very favorable. For nonprofits, it's 2.75%, and for businesses, it's 3.75%. There is collateral required if your loan is over, if you request a loan over $25,000. So keep that in mind. In addition, if you are looking for a loan of over $200,000, you will also need a personal guarantee. Unless you're a nonprofit or an ESOP, then you will not need a personal guarantee. There are also now filing fees associated with applying for this loan. It's fairly small, but it's $100 for any loan request over $25,000. So keep that, again, something to keep in mind if you are thinking about applying for this loan. Specific things that it cannot be used to pay for are making prepayments on debt that is owned by a federal agency, or to start a new business, or to expand your current business. So you can't be making additions, you can't add a new business segment. Again, this is to cover any essentially working capital losses that you've incurred as it relates to the pandemic. So this is a really good opportunity if you are still in need of some funding, to kind of something to help get through into next year. This is available. I've had quite a few clients that did need this funding and they accepted the $25,000. So there was no collateral or personal guarantee required, and it helped get them through, a difficult time. So be thinking about this if you are in need of some additional cash. Dan, were there any questions on this information that we wanted to address now, or hold till the end?
There's one question here. We can probably address it now.
Okay.
And that is, could you please provide examples to the following requirement for PPP forgiveness for the covered supplier costs? It gives the full explanation, but they're asking about those covered supplier costs.
Sure. So if the covered supplier costs were fairly specific, that you essentially needed to have a contract with a vendor or a regular recurrence with a vendor, for most organizations, you might be thinking the cost of goods sold. I realize that doesn't apply for all organizations, but essentially it's the cost to cover your supplies that you need to do your day-to-day business. So it's not necessarily cost of goods sold. It also includes supplies pursuant to a contract that existed before you applied for the PPP loan. So typically you're going to need to have some sort of purchase order or contract in place. The only exception to that is for things like food and beverages. So if you're a restaurant, you didn't need to have a contract in place prior to using those funds to cover those costs. Hopefully that answers the question.
And then the second question pertains to EIDL, and that is, are you aware of any co-ops that have gotten around the personal guarantee issue, EIDL?
So it depends on the bank that you're using. There is no exception for cooperatives in the SBA's guidelines. And if you bank with, a traditional, like a Chase Bank or First Business Bank or, BMO, the likelihood is that you're still going to need a personal guarantee if you're looking for a loan of over $200,000. However, we have been in communication with banks that work specifically with cooperatives. NCB is one of those banks. They do not require a personal guarantee. They have been able to negotiate around that with the SBA. So if you are looking to apply for an EIDL greater than $200,000, I would reach out to banks that specifically work with cooperatives. NCB is one. CoBank is one, although I don't know what their rules are related to the personal guarantee, if they are making an exception for cooperatives, but I know for sure that NCB is one. So I would recommend reaching out to that bank if you aren't currently working with them.
That was it so far.
Okay, great. Well, Dan, I'm going to go ahead and turn it over to you to wrap up our last couple topics.
All right. So the first one is FFCRA. This was part of the CARES Act back in March of 2020, and it's essentially sick paid leave for individuals that whether they've contracted COVID-19 or if they have a family member that maybe they're caring for. or they were exposed to it and they're out of work because of it. This program was renewed at the end of last year, and it was renewed it was originally through the first quarter of 2021, and then it got expanded as an optional item through September 30th, but that is gone now. So if you do have employees that are out of work because they've contracted COVID and they're out for a couple weeks, there's no more paid sick leave that you can receive a credit for. And these credits were payroll tax credits, where any wages paid and payroll taxes and health insurance for those employees would have come back in the form of a credit. So if you did have sick pay leave potentially for your organization that you paid out under this program, but didn't realize you were supposed to take a credit for it, you can amend your 941 forms to claim those credits. And then the last item here is any credits claimed for FFCRA purposes are not eligible payroll costs for PPP or for the employee retention credit. Again, you can't have a double benefit essentially on a government program. So next slide. And we're gonna dig in a little bit, not too much, but kind of a high level overview of employee retention credits next. So I'm gonna kind of walk through some of the history. You know, I've kicked around whether or not I want to try to nail down all these acronyms and what they actually stand for, and I think I might give it a shot here. So first, in March of 2020, there was the CARES Act, and I believe that was the Coronavirus Aid, Recovery, and Economic Security Act. And that started the employee retention credit. And it made it eligible from March 13th was the first day that it started through December 31st of 2020. Then at the end of December in 2020, there was the Consolidated Appropriations Act. And this expanded the employee retention credit to Q1 and Q2 of 2021. But for, I guess, more importantly, kind of looking back, it also made businesses and organizations that took out PPP loans eligible participants. Originally in the CARES Act, if you took out a PPP loan, you could not participate in the employee retention program. It was the either or. And then with the Consolidated Appropriations Act, they expanded it into 2021 and also made it eligible for PPP loan participants. Whether you took out PPP loan 1, PPP loan 2, or both, you can still qualify. Then in March of 2021, there was ARPA, was the American Rescue Plan Act. And that expanded the employee retention credit to Q3 and Q4 of 2021. Most recently, just on Monday, President Biden signed into law the Infrastructure Investment and Jobs Act. And that act retracted the employee retention credit in Q4. There was an exception for recovery startup businesses. I'm not going to dig into those too much. That's essentially if there was a business that met certain thresholds that started during the pandemic. You may still be able to claim it in the fourth quarter. But largely what that act did was it retracted ERC in Q4. So the employee retention credit now expires after the third quarter for the vast majority of organizations. So I'm just going to touch a little bit here on qualifications. It's a either or, it's not both. So the first one, there is a gross receipts test, which we'll talk about on the next slide. And then the next one is if you had operations that were fully or partially suspended during any calendar quarter of 2020 or 2021, essentially due to a government mandate. And you know, the spirit of this, I think it's gotten confused a little bit. What this is really trying to get at is, you know, were you a restaurant where you couldn't have in-person dining? You really had severe impacts. You know, were you an organization that normally has live events or has events and you couldn't do those anymore? Those either were somewhat moved to virtually or completely suspended. And those suspensions impacted gross receipts. So they impact revenue. So the next slide, we'll talk about gross receipts a little bit here. I got a little wordy on these, but I feel like I kind of had to. For 2020, the gross receipts test is looking at 2020 quarter versus the 2019 quarter. If there is a larger than 50% decline in gross receipts in the same quarter, then you can qualify. and you start qualifying in that quarter that you meet that gross receipts test. You continue to qualify until you have a quarter where in 2020, the gross receipts are more than 80% of what they were in the same quarter in 2019. I've got a little spreadsheet that's on the slide deck here shortly that'll kind of explain these in better detail and kind of give you a picture of, what am I talking about in text versus actual numbers here. And then in 2021, that 50% threshold was moved to 80%, and it actually made it a lot easier for businesses and organizations to qualify. We've had a number of nonprofits that have qualified. We've had construction companies, we've had retail, we've had restaurants, we've had event centers, we've had hair salons, and any type of business that's been impacted with gross receipts, or any business potentially that had a really solid year and high gross receipts in 2019, can qualify for this. And another kind of nuance, which again is on the spreadsheet I'll be talking about shortly, is that there is an alternative method in 2021 to help businesses qualify. So if you want to go to the next slide here. So get your readers on if you're having a hard time reading this. But this is a spreadsheet we've kind of developed internally to help determine if our clients might qualify. And we've got columns here, as you can see, for 2019, 2020, and 2021 gross receipts. Then we've got columns for decline in 2020 and decline in 2021. Now, 2019 for measuring 2020 and 2021 is the baseline year. So you're not measuring anything with 2020, you're measuring 2020 to 2019 and 2021 to 2019. So these columns with declines in gross receipts, I had just said in 2020, there has to be over a 50% decline to qualify. So if we follow this column for decline in gross receipts 2020, there's a 20% decline in the first quarter. In 2020, it's got to be over 50%. So you look at the second quarter, they're over that 50%, and you can see they're a qualifying quarter in 2020. They continue to qualify until you have over 80%. So if we look at the third quarter, the third quarter actually was higher revenue in 2020 than it was in 2019. And because of that, that is the last qualifying quarter. So again, just to specify, you do still qualify in the quarter that you go above 80%, but that's the last quarter that you qualify. Again, we look at the fourth quarter of 2020, it was not a 50% decline, so they don't qualify. Going into 2021, in 2021, if we look at the first quarter was actually better in 2021 than it was in 2019. And this is where it can be confusing, but there's also an alternative method. And that alternative method in 2021 looks at the prior quarter. So in the first quarter, it says here qualifying quarter based on alt method. That's the alternative method, where you're looking at what happened in the prior quarter as opposed to just looking at what happened in the current quarter. When you look at the prior quarter, that's the fourth quarter of 2020 versus fourth quarter of 2019. There's this decline of 27%. And because there's this alternative method, you use the current quarter or look at the prior quarter. This prior quarter in quarter 4 of 2020 is more than a 20% drop. And therefore, this organization or business would qualify in the first quarter. Even though the first quarter gross receipts were higher, they looked at the prior quarter, you look back for this alternative method, and you can use that to qualify. Again, in the second quarter, they had a lower second quarter, they had a drop of 25%. That's greater than a 20% decline, which is the test in 2021. They qualify for that quarter. And then again, the same thing that in quarter 3, there's this alternative method again, where they use the prior quarter to qualify for the following quarter. And that was guidance that the IRS came out and issued in August. Originally, the legislation that Congress had passed simply said there's an alternative method, and then there's looking at the current quarter method, and they didn't say, do you use one, do you use both, what can you do? And the IRS came out and clarified in August that there is nothing saying you can't use both methods and pick the method that works best for you in any particular quarter. So in this situation, this business or organization had a decline in the fourth quarter of 2020 and in the second quarter of 2021, but they ended up qualifying in all 3 quarters using the regular method for the quarter and using the alternative. So hopefully this picture helps kind of display it a little bit. Next slide. So I'm just going to touch, not a lot, but a little bit on, what are gross receipts? Gross receipts are total sales, net of returns and allowances and all amounts that are received for services. It includes investment income, dividends, interest, rents, all of those things are included. Now, what is not included is unrealized gains. So if you're a nonprofit organization and you've got an investment account, and that investment account, has gone up, say 10% during a particular quarter. If you didn't sell anything from that investment account, any interest or dividends you might have would be included in gross receipts. But any just unrealized appreciation in that account, you're not going to pick that up as gross receipts unless if you actually sell something. And that's what I've got something on the last bullet point here. So gross receipts are not reduced by cost of goods sold. They are generally reduced by a taxpayer's adjusted basis in certain property used in a trade or business or capital assets sold, except for tax exempt organizations. So I'll kind of walk through an example here of, what does that mean? That means if you are a for-profit organization, let's say you have an investment account, you sell an investment for $100,000, and that stock was worth $50,000 for the basis. 100 minus 50 is 50,000 gain. That's what's going to be included in gross receipts for a for-profit organization. For a tax-exempt organization, if you sell an investment for 100,000, it doesn't matter what the basis in that stock might be or what the basis of that investment is. That 100,000 is the number that's part of gross receipts. I don't know why they differed. It may have simply been that if nonprofit organizations have large fund reserves and they're using those, they just want to include that whole thing as part of gross receipts.
And there's one question that I think we'll probably want to answer live before we move forward. It's related to ERC and the partial or full suspension. So the question was, if we had to partially shut down, do we still need to do the gross receipts test?
So it depends. If you are shut down for part of a quarter, then yes, you would still want to do a gross receipts test, because let's say, for example, you were shut down from middle of March to middle of May in 2020. You're going to want to look at the gross receipts test because the partial suspension only applied from mid-March to mid-May. You don't get the credit for the entire second quarter. If you meet that gross receipts test, then you get the credit from March 15th to the end of March under the suspension of operations, and April 1st through June 30th for the entire second quarter, because you met that gross receipts test. So if you're in a situation where it's the entire quarter that you're partially suspended, you don't also have to meet that gross receipts test. But if you're in a situation where your partial suspension of operations is only a part of a quarter, you're going to want to look at the gross receipts test to see potentially if you qualify for a longer period of time. Next slide. So qualified wages are gross wages plus the employer portion of health insurance. There's kind of a full-time employee count limit here. And for the 2020 credit, if you're over 100 full-time employees in 2019, then it's only applicable for employees who are paid while not working. If you're under 100 full-time employees for 2019, it applies for all employees. And the qualifying wages didn't change in 2021. It's still gross wages and employer health insurance. And that limit went from 100 up to 500. The one thing I'll kind of add on here is this is not full-time equivalent employees. if you're a business that has, or nonprofit organization that has 80 full-time employees and 80 part-time employees, this is only based upon full-time employees. So this test looks at number of full-time employees per month in 2019, take that total divided by 12. So we have had a number of organizations that have had well over 100 employees and maybe over 100 full-time equivalent employees, but this is just based on full-time employees. Part-time employees don't count for anything for purposes of this test.
Dan, can you specify what a full-time employee means for ERC? Because I know it was different for PPP than it was for ERC.
Yeah, so for ERC, a full-time employee is an individual that works over 30 hours a week or 130 hours in a month. So what we've done with a lot of our clients who may have an issue with number of employees for this test is we've simply taken their employees' monthly payrolls and looked at the number of hours they have per employee. If you're over 130 hours, you count as one. If you're under 130 hours in the month, you don't count as any. Next slide. So the credit is very generous, and it got a lot better in 2021 as compared to 2020. The 2020 credit was up to $5,000 per employee annually. And one thing I didn't touch on yet, but I'll kind of just bring up briefly here is the employee retention credit versus PPP loans, because a lot of businesses and organizations didn't even know they could claim the employee retention credit until legislation at the end of 2020. The IRS came out with guidance and said, essentially, you can't use the same dollar twice. If you're using $1 of wages or employer health insurance for the employee retention credit, it can also be used for PPP forgiveness. And what we've kind of done with a lot of clients to combat this is we've got templates and things that we've built. In addition to that, another helpful piece of information to know is if you had a PPP loan for, we'll say, $200,000, and you submit your forgiveness application, you send them payroll reports that are for $350,000 of wages. You submitted a forgiveness application that had an excess of $150,000 of wages on it. Those wages are available for the employee retention credit because they didn't need to be used to fulfill the loan. And same thing in 2021. Kate had talked about PPP and those forgiveness applications. I always recommend take a quick look at your gross receipts. If you maybe meet this test, maybe put pause in your PPP forgiveness application and look for what are other payroll costs that qualify for PPP that don't qualify for ERC. What are some of your potential facility costs for rent and utilities and interest paid on any debt obligations you might have? And look at those and maybe use those for part of your PPP loan forgiveness so you get the best benefit out of both of the programs. In 2021 credit, it's up to $7,000 per employee quarterly. So if you qualify in 3 quarters in 2021, it could be up to $21,000 per employee, where it's $5,000 per employee in 2020. So the credit does get more generous. And the dollar amounts get a lot higher in 2021. So here's some frequently asked questions that we've been seeing. Where do I claim this credit? The answer to that is on a form 941. If you do not claim it on an original 941, which obviously you can't do at this point because it's now expired as of the end of the 3rd quarter, you can file, or you can have us help file a form 941X. That's an amended payroll tax form. Now, how long to get my refund? There's kind of 3 options in this regard as far as when you're applying for the credit. If you electronically file a 941, you might see a refund in 4 to 6 weeks potentially. It comes by pretty quickly. If you paper file an original 941, it could be anywhere from 4 to 6 months. I've seen clients get them as soon as 2 to 3 months, clients as late as 6 months. And if you file an amended 941, it could be 6 to 8 months. It potentially could be even longer than that. We've had some clients that have filed very early in February on amended 941s, and they just received their refunds a couple weeks ago. So we have seen people starting to get those refunds. It's very slow going. I'm not going to make any excuses for the IRS, but they have been inundated with a lot of additional programs to administer and a lot of these forms to process, and they were already extremely far behind at the end of last summer and fall when they started going back to processing them. The next one, does the IRS pay interest? Yes, the IRS does pay interest on these refunds. So the refund amount typically you're going to get is going to be larger than what's on the 941 or 941X filing because there's going to be interest paid on it. Do owners' wages count? It depends is the answer to that. If you have any owners that own over 50% of the business or collectively with related parties, so if it's a husband and wife that own 50-50, if it's two sisters, two brothers that collectively own over 50%, parents and children collectively own over 50%, then any related party's wages do not qualify for the credit. However, if you have, let's say, for example, Kate and I are not related. We own a business called PPP and ERC Stuff, and we're 50-50 owners. We are not greater than 50%. Our wages would qualify, and any of our family members could also qualify. Are there rules for ownership in multiple companies? There are, yes. If you have a partial suspension of operations in one company, then it can constitute all of the companies qualifying. If you have one company that meets a gross receipts test, but you own 3 or 4 other companies, all with the same ownership, and you combine everything, and either you do or you don't meet the test. If you do meet the test, all the companies qualify. If you don't meet that gross receipts test when combining everything together, none of the companies qualify. So can Wagner help with this? Yes, we are helping clients with these calculations and with these amended 941s. If you would like assistance, we're happy to help. From a kind of a staffing and workflow perspective, a lot of the work we're getting done now we'll be able to do in November, December, and January. Once we get into later January and February, a lot of our consulting engagements on these are going to be delayed until after April 15th when we've got this staffing capability to work on them. Is there an alternative quarter selection? Yes, there is for 2021. We walked through that on the gross receipts spreadsheet. Is ERC still around for Q4 of 2021? No, it is not, unless if you are a recovery startup business again, and the stipulations for that are pretty specific. The last one is this program for real? We've heard that from a lot of clients after completing the calculations and amended 941s and communicating them, how large these refunds are. And yes, it is for real. We've had clients that have gotten these refunds already, and it's real money. So it's certainly worth the due diligence to take a look at and see if you meet the gross receipts test, or if you had suspensions of operations under a mandate, then to really identify and kind of look at this. Next slide. And I just put one slide together here on, what are the tax impacts if you participate in these programs. For PPP, it's tax exempt for federal taxes. So you are not paying any tax on your PPP forgiveness. And most states have accepted this practice as well. We're in Wisconsin. Wisconsin specifically has accepted this practice. Like I said, most states have. You'll have to look at your individual state if you're filing elsewhere. SVOG, that's tax exempt. RRF is also tax exempt. ERC is the only one that really has a tax impact on these. And from a federal tax perspective, the amount of your employee retention credit is a loss of a federal wage deduction on income tax filings for businesses. So if you're a tax exempt organization, this doesn't really impact you. If you are a for-profit organization, whether you're a corporation, partnership, sole proprietorship, you do lose a federal wage deduction for the amount equal to your employee retention credit. Most states are still allowing the wage deduction because it is a federal credit. And one other thing to kind of specify here is if you are, let's say you're claiming a 2020 credit now because you found out that you qualified and you want to take advantage of this program, that non-deductible wage applies to your 2020 tax return. So whatever quarter of the year that you're taking it in, it applies to that year. Even if you don't get a refund, let's say until the summer of 2022, for a 2020 credit, it still is non-deductible in your 2020 return, so that will need to be amended if it wasn't already claimed on the return. So we've
And
got
we
some
do
of
have
our
a couple questions too, so.
sure.
So these are all ERC related, so I'm just gonna go ahead and fire them off to you.
Yep.
So the first one.
I can see them
Oh,
here.
okay, go ahead.
So the first one is, do you qualify for ERC if one major department has a severe loss of revenue? And you would have to look at the gross receipts test. And that gross receipts test would be for the entire organization or business. If you do have this scenario where let's say you've got a business that had some of the activities that were suspended, but not all the activities. If there's additional items in that regard where if you were over, if it's over 10% of any quarter of 2019's gross receipts impact, then you can qualify. So it gets a little bit technical, but an example of that would be, let's say you've got a business that will just we'll pick on attorneys. Say you got a law firm. Your law firm does a huge litigation practice, and that litigation practice could not do anything in person because courts were completely closed down and you lost a ton of revenue. But that's one department out of the entire firm. If that constituted over 10% of your revenue in 2019 on a quarterly basis, then you could qualify. So that kind of answers the second question as well. If a line of service was shut down by government order for the entire quarter, but not the entire business, you still need to meet the gross receipts test. You do not still need to meet the gross receipts test. If there was a partial suspension of operations, as long as it makes up the correct portion of the business, again, that test is at least 10% of the revenue or the labor hours on a 2019 quarterly basis. So essentially it's looking back at 2019 quarters and this make up over 10% of revenue or 10% of labor hours, then it's deemed to be more than a nominal portion of the business. And that partial suspension of operations applies to the entire business. Qualified wages, the first 10,000 in 2020 in each quarter, in 2021 or the 50 and 70%. So the amount of qualified wages on the 941 is the first 10,000 in 2020 and each quarter in 2021. And then there's a calculation that'll calculate the credit at 50 or 70% of those wages. There's a couple additional questions here. One is for ERC, what about a partial government order shutdown that saw a reduction in revenue or wages for a department in my store? Example, in-store dining for a grocery store that was closed, a deli was greater than 10% of store sales or 10% of wages. So again, this goes back to, let's say you've got a grocery store and there's a restaurant kind of within the grocery store, in-store dining where they're selling, different food products you can sit and eat at the store. If you have over 10%, if that kind of deli area makes up over 10% of the total revenue in a 2019 quarter for a store, or if it's over 10% of the labor hours in a quarter, which typically a deli is pretty labor intensive, then that organization, department store could qualify for the employee retention credit because there's a mandate that limited indoor seating and the services they could offer for in-store dining, which would have had an impact on their gross receipts. Next one here is, can you explain the alternative method of qualifying for ERC? Could you maybe go back, Kate, to that one slide, and we'll just take a quick look at that again. So for this alternative method, again, it's based upon looking at a prior quarter to qualify for the current quarter. So if we look at this decline in gross receipts in the second quarter of 2021, because the decline was more than 20%, they can use that in the third quarter to qualify based upon an alternative method. You're looking at, did you meet the test in the prior quarter? If the answer is yes, you can qualify in the following quarter. Again, this is the same thing. In the first quarter of 2021, you look back to the prior quarter, which is the fourth quarter of 2020, declines greater than 20%, so you qualify. And once again, this alternative method is only available in 2021, not available in 2020.
Looks like that is all the questions we have. So Kristen, I think we're probably ready to wrap up for today.
Thank you so much, Kate and Dan, for all of your expertise today. Everybody can keep an eye out for an email from me in a little while with a link to the recording and the PowerPoint slides. And Kate and Dan's contact information will also be included on those slides, and you can see it here. Feel free to reach out if you have any questions that come up after this. Thanks so much for joining us, and we hope to see you again next time. Have a great day.